The dovish Fed comments are well heard. The hawkish comments go completely unheard. The US equities renew records as the US dollar continues to lose field against its major counterparts. Yet, the US economy remains strong. Inflation in Europe eases, and what we see in the market pricing today is, well, not exactly what you would expect to see. So welcome. This is Swissquote's Daily Market Talk. Isn't it amazing how investors ignore the hawkish Fed members but fully embrace the dovish commentaries? So if I tell you that the Federal Reserve's Thomas Barkin's words that suggested yesterday that the Federal Reserve could actually cut the interest rates if recent progress in inflation continues sent the Nasdaq 100 index to a fresh record for the third consecutive session and the S&P 500 to a fresh year-to-date high and near an all-time high record as well, you shouldn't ask me why on earth all the other central bankers' warnings that it could be a bit too early to cut the interest rates didn't see the same enthusiastic reaction from investors. Because, well, you know what? I don't know. The trend is your friend. Those are your friends today. The hawks are clearly not your friends. And that's, I guess, the magic ingredient to ensure a Santa rally this December. But the thing is, as Mohammed El-Erian said, well, the Fed communication confuses people, and that he actually thinks that we have a real problem there. And I would add to that the reaction to Fed communication is also confusing, asymmetric, and worrying, because investors are dreaming of aggressive interest rate cuts next year in an environment of strong or resilient or okay economic growth, and that is not the right recipe for easing inflation and keeping it sufficiently low for the Fed. So something must give. Either the data will confirm an economic slowdown in the US, in which case the Federal Reserve could loosen the financial conditions without worrying about inflation, and that should continue to weigh on the bond yields, or the economy will continue to show resilience and strength, and that's also partly thanks to a decent fiscal spending into next year's election in the US, and then the Fed will keep its purses strings tight enough to maintain control on inflation, and while the bond yields should dip and eventually rebound. But in both cases, what's quite intriguing is what's going on the equity front, because the S&P 500 stocks are now trading at nearly 20 times the 12-month earnings estimates, and the trailing 12-month EPS estimate is at a record right now. So this estimate is supposed to give an insight into the overall earnings performance of the companies in the S&P 500, and well, you would agree with me that the numbers don't look like an economy on the verge of recession. This being said, the latest FedEx results actually didn't enchant investors yesterday after the closing bell. The company, which actually serves as a gauge of economic activity and strength, well, missed expectations due to declining air freight and trucking volumes. So the shares sank more than 7% in the after-hours trading, and the sell-off will likely send the FedEx stock below its uptrending channel that's been building since last October, and of course on the back of the falling US yields. But that negative correlation between the FedEx stock price and the US 10-year yield is right about to break right now, as FedEx, like most of the stocks out there, can't continue to rise just because the yields fall. Because a further fall in yields implies a decent economic slowdown, and that ain't good for earnings, the earnings expectations, and hence the company valuation. So we will continue to watch how the earnings expectations will evolve given the softening Federal Reserve expectations. But at the current levels, note that the S&P 500's earnings yield with forward estimates stands at around the 4.63% level, and that's significantly better than the 10-year yield, which is around the 3.90% level of right now. So if there is one sweet spot for those looking for good deals in this market, well, it's the US 2-year bond, which yields around 20 basis points less than the S&P 500, but where you know that you will get your capital back at maturity. In the FX markets, while the weakness in the US dollar hints that the Federal Reserve does remain clearly in charge of the market, and that despite the strong economic data and strong profit estimates for the US economy. Released yesterday, the latest housing data in the US actually showed that housing starts jumped nearly 15% in the month of November as the mortgage rates dipped from above 8% to below 7% thanks to a swift fall in the US yields. So that's obviously a good sign for the US economic health, but not necessarily for the future path of inflation in the US. Another place that's quite interesting to watch is the falling US deposits. So the US bank deposits were around 80% at the peak of the pandemic, and they are now reverting toward the norm before the pandemic of around 60%. So the melting excess savings and the melting deposits could slow down the US economic growth, and that could tame inflation. But Atlanta Fed's GDP now points at a 2.7% growth in the US GDP in the fourth quarter. And Thursday's official data will remind us that the US economy grew more than 5% in the third quarter, which is a number that should actually raise questions regarding the dovish Fed optimism of today. Because even though we see this US economy slow down from that 5% peak of the third quarter, well, it wouldn't immediately mean that things are not going well for the US economy. And this is why I actually find the Fed dose optimism a bit overdone given the strength of the underlying economic data and the upside pressure that we see today on energy and shipping costs due to the fact that the world's leading energy and shipping companies have just started this week avoiding the Suez Canal in the Red Sea due to the Houthi attacks. In the sense, the barrel of American crude is now preparing to test the $74 to $75 resistance region, and a stronger positive momentum could finally turn the bear's fortune. If that's the case, your Fed optimism should actually take a hit sooner rather than later. Now, as worries regarding the implications of developments that we see in the Red Sea region mount, latest inflation numbers from Europe and from Britain actually give some good respite to investors, because inflation in the Eurozone slowed to 2.4% in November and core inflation fell to 3.6% as expected. But you could barely guess the good inflation news watching the Eurodollar advance toward the 109.90 level yesterday, as the broad-based weakness of the US dollar weighed heavier than the soft Eurozone inflation figures. But again, this morning in the UK, both headline and core inflation numbers fell faster than expected by analysts in November, because headline CPI slipped below the 4% mark as core inflation eased to 5.1% level. Cable obviously slipped below the 127 level as a knee-jerk reaction to the softer than expected inflation figures. Yet, in absolute terms, core inflation in Britain is still more than twice the Bank of England's 2% inflation target. And even though the pace of easing in this inflation is more than welcome, the Bank of England is still perhaps last in the line to join that private party. Therefore, the relatively hawkish BOE expectations should limit the pound sell-off if, of course, investors continue to divest from the US dollar on the back of these softening Federal Reserve expectations despite all the strong economic data. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. And subscribe to our YouTube channel for daily market comments. And please do not forget to hit the like button to let us know that you enjoy these videos. So I will meet you again tomorrow. And until then, good day trading.